Good afternoon to all of you. We are going to be starting the webinar session. I think today's session will actually be divided into two parts. The first part we will cover the understanding the financial statements. The second part of the session today will focus on the ratio analysis and interpretation. Now, once those two sessions are over, we will take up questions at the conclusion of these two sessions. Starting with the I think the earlier session that we had a couple of weeks ago, we had sort of touched upon in terms of why do you need financial information. Now, the answer to that is the various stakeholders in the company, which could be shareholders, suppliers, the customers, the tax authorities, the employees, the society at large. Each one of them will have different questions for which they would seek answers from the companies. So some of the questions typically that would need to be answered would be in terms of what are the resources which are currently available with the company, what sort of entities have financed the company, meaning who are the banks, who are the financial institutions, who are the other lenders who have financed the company. The third point being how has been the profitability of the business over a period of time, as also what is the financial position at a given point of time. The fourth question that one would like answers for would be in terms of the performance of the company over a time frame. It could be a 3-year time frame or a 5-year time frame, as also what has been the performance during the current year or current financial year. Likewise, in terms of, I think when we talked about it last time around, also we talked about how the cash flow statement is important. So one would also like to know the various sources and uses of cash over a point in time, as also whether the company is reporting a cash surplus or a cash deficit at the end of the year. Not only that, many times the financial statements will also enable stakeholders to set out performance norms and also impose certain restrictions of governance on the management of the company. So these are some of the broad and major questions for which one would need to have answers for, and therefore the importance of having a financial information statement, so to say. And the other important purpose that financial information also provides is it also provides a convenient template for planning and also for projecting the financial performance in the next 2 to 3 years. And I'm sure that most of you are attending here also would be familiar with the budgeting process which happens in each of your companies. So when the top management is looking at a budget not only for the next year but also for the next 3 to 5 years, one of the outcomes of all the discussion that happens is the financial projections or the financial numbers. Typically, what is the turnover of the company, what is the profit, what are the various cost elements that go into it. Anyway, we are going to be talking more about it as we go along. So to answer these questions, accountants typically prepare two financial statements. One is called as a balance sheet and the other is called as the profit and loss account. And the cash flow statement is an ancillary statement which is derived from the numbers of both the balance sheet as also the profit and loss account. So if you look at it, what are financial statements? Any business that you do, at the end of it, it has to be measured by some tangible output, and that tangible output is in the form of numbers. And those numbers typically are the ones which constitute the financial statement. So the financial statement will, in essence, summarize the financial status of the company and also provide overview in terms of the financial performance of the company. Now, if you look at financial statements, some of you would have seen it, some may not have seen it, but typically these are publicly available for widely held companies. I think we talked about the different type of companies when we touched upon it the last time around. And you could either visit www.bseindia.com, which typically would have all the companies which are listed on the Bombay Stock Exchange, or you could visit www.nseindia.com, which is a national stock exchange and has a wide coverage in terms of the companies which are listed out there. Not only that, for closely held public companies and private companies, these reports or the financial statements are reported to the Ministry of Company Affairs. And again, you can visit the website www.mca.gov.in. And many times you can either pay a small fee and get hold of those annual reports, or you can also view those annual reports on screen. And maybe at the end of this session, I think all of you should make an attempt to go through the annual reports of each of your companies so that you know how your company is performing, and also try and make some sort of analysis based on what we'll be doing today. And also, one of the things that I have also set out today is to take you through one of the annual reports of a company, basically to give you a flavor in terms of what is the sort of coverage that typically happens in an annual report, and what are some of the key highlights that one would want to know as you go through an annual report. Sometimes, one wonders whether you should know a lot of accounting, or is it good enough to know the financial statements and the analysis. But I think for the purpose of your day-to-day job, you're not expected to be knowing a lot about accounts. I think your task will be in terms of knowing what is there in an annual report and how we are going to interpret some of those numbers. But nevertheless, some of the broad accounting principles are one is the double entry system, where typically the debits and credits that typically you find in the accounting ledger, which eventually gets translated into a profit and loss and the balance sheet entries. The second important principle is accrual accounting. Accrual accounting means that in the books of accounts, you will accrue. For instance, if you have sold goods worth 30 crores or 40 crores, in your income statement, you will show that 40 crores, expecting to get that 40 crores over a period of time. It may not happen that out of the 40 crores, at the close of the financial year, you might only get 30 crores. The balance 10 crores could be in the form of receivables or debtors. So accrual accounting would mean that whatever income that you have actually contracted for, let's say you've sold 30 or 40 crores, that 40 crores will have to be accrued. Earlier on, most companies, and in fact all companies, are expected to be following the accrual system of accounting. The third concept is called as a going concern concept. It means that the assumption is that the company is not going to go bust or going to go under tomorrow. It assumes that once a company is formed and they have their own plant and machinery and assets to start with the operations, the assumption made is that the company will continue to function and keep going on. So that's called as the going concern concept. Because last time we had talked about depreciation being amortized over a period of 5 years or 7 years. Even there, the assumption is it's a going concern principle, because company will continue to exist over a period of time. The fourth concept is called as a materiality concept, which means that there are so many expenses that you will incur in your day-to-day operations. So when you actually group it, and we will see when we actually go through the annual report, there are certain standardized accounting heads which have been prescribed by the Institute of Chartered Accountants. materiality concept means that that particular expense will need to be material in nature to find effect in terms of a particular accounting head entry. For instance, raw material is a head wherein you will typically put together all the key raw materials that you have in the company, or many of the expenses that are pertinent to spare parts, for instance, or spares consumed, will get accumulated or clubbed there. So materiality in effect would mean that if the expense is very material and there's already a head for it, you will push in all those expenses there. But if there are very small expenses that are being incurred by the company, which are, which do not have a very specific head, then you'll try and combine it into a logical accounting head. So these are some of the broad concepts on the accounting side. Now, in terms of the accounting standards and its importance, basically the reason why I put these slides is you need to know what are the accounting standards in the Indian context. Now, some of you might have read about the International Financial Reporting Standards, or which is called as the IFRS. Now, what the Institute of Chartered Accountants have decided to do is to converge 32 of its accounting standards with the IFRS for accounting periods which are commencing on or after April 1, 2011 in a phased manner. And this is basically, that is a roadmap to meeting the International Financial Reporting Standards, and this is something which has been prescribed by the Ministry of Corporate Affairs. So for the moment, it has been decided that there will be two sets of accounting standards under the Companies Act. The new set of standards, which have now been converged with the IFRS, is now known as the Indian Accounting Standards, or IND AS. So both of that will run parallelly, both the existing standards and also the converged set of standards. Now, as of 2011 February, the Ministry has notified about 35 IND accounting standards, and the Ministry is still not specified the exact way in which the whole thing, date of implementing the entire new set of accounting standards. Now, the transition to the new accounting standards will happen in a phased manner, depending on the net worth of the company, because they would first like to have the larger companies move to this first, and then the medium-sized companies, and then the really small and medium enterprises. So there are the 32 standards, for instance. I'm not going through each of it, and this is something that you can see it later. For instance, there is something, if you look at IND AS7, it basically describes how the various cash flow statements have to be presented and how they should be categorized, and what are the various heads and subheads which will come under that. For instance, if you look at the next slide here, in AS27, for instance, we'll talk about consolidated and separate financial statements. Let's take the example of a company which is having a subsidiary company. So typically, IND AS27 will prescribe how the standalone financial statements of the company will have to be set out, and also you have to consolidate the financial statements of the subsidiary. A subsidiary is a company wherein the parent company has 51% or more shareholding. So you also look at consolidating the accounts of the subsidiary along with the parent company, and look at a consolidated financial statement for the combined entity. So on and so forth. There are various standards for leases, employee benefits like ESOPs, for instance, or gratuity, pension, and so one might ask, why should we have uniform accounting standards? Now, the answer for that is, if all entities have uniform accounting standards, one, the financial statements become comparable. For instance, if you want to study the financial statement of your competitor, and if they were following a very different accounting standard, you will not be able to compare the financial performance. The second point being, it makes the whole process of accounting very transparent, because you know that if everyone is following the same standards, then the same amount of transparency will be there in each and every company's financial statements. And the third point being is the reliability of the information which is provided, which becomes standardized across all the companies. And for the smooth functioning of capital markets in our country, you need to have entities adopting uniform accounting standards. The second important point is investors, whether these are Indian investors or global investors, will need to have comparability of financial statements in a very uniform manner, because they're putting the money into a company assuming that the financial statements which are shown are true and fair. And the more that you move towards the uniform accounting standards, I think the comparability also becomes a lot more easier. The third important point is with the effect of globalization fairly well entrenched in the Indian market. I think global operations also mean that you cannot have different accounting standards for companies that are operating in different geographies. For instance, the company, let's take Ford, for instance, has operations in the US, it has a setup in India, and it has setups in other parts of the country. Now, if they have to compare the performance of each of the country's operations, then it makes sense to have one uniform accounting standard so that they can decide on which entity is performing better than the other entity and focus their energies there. Otherwise, there is a cost attached to having different accounting statements and trying to normalize it to a standardized accounting standard. So from a global perspective also, it becomes extremely important to have a uniform accounting standard. In terms of disclosure, and I think this is very, very important, and since a lot of guidelines have come into place, by and large the disclosures which companies have to be making in their financial statements is fairly well standardized. And it is important that all stakeholders have a fairly good access to the relevant information that they are seeking, which means when we talk of relevant, it means that any material or anything which is relevant, which is to be brought to the notice of stakeholders through the financial statement, has to be brought out. And the information that is going to be disclosed should be full, it should be fair, and it should be adequate. So that is a key point. When you talk of adequate, it means that a fairly sufficient set of information that is required is put out in the financial statement. And when we talk of fair, it means that it assumes that all the users of the financial statement enjoy equitable treatment. It should not place one user of the financial statement at an advantage or disadvantage vis-a-vis the other user of the financial statement. And full means a complete and detailed presentation of the information which is provided to the users of the financial statements. Just to give you some example, for instance, now one of the examples here is let's assume that the company's net sales are 1,50,000. Now it is important for interested parties to know that the gross sales was 2 lakh rupees and sales return is 50,000 rupees. Now when you talk of sales return, it means that products have been returned to the company either because it is defective or there's some problem with the product. Now this disclosure of this 25% of sales return is very, very important for various users of the financial statement. It means that it could signal that there could be a quality issue with the particular product which has been sold, which has caused the returns of these products in the marketplace. Now in our day-to-day context, I'm sure that many of you would have read in the newspapers, for instance, Sony Television, for instance, that sometimes they find that some of the television sets or a particular batch of television sets which they have sold are defective in certain parts. Or more so in the auto sector, you find that Toyota recently, I think, called back a lot of their cars, a particular brand of cars, because there was a particular problem with the component. Or Nokia, for instance, I think one example which comes to my mind is their battery charger, which had to be recalled because there was the problem. I think those examples are many. Now the point is that had they only shown 1,50,000, you and me would never have figured out that 50,000 was actually returned out of a total sale of 2 lakh. The second important point is in the balance sheet, which we will talk about a little later. How do you value the assets such as investments, inventories, land and building, etc. should be very clearly stated, because all of this is money. The inventory that you have is actually cash. The land and building that you have is actually an asset which can give you cash when you sell it. Or the investments that a company makes either in some other company or in some other fixed deposits or other instruments is all something which can be translated to cash. So how you value that becomes very, very critical, and that needs to be very clearly specified in the annual report. Thirdly, also is any method of depreciation that you change. I think we talked about straight line method and return on value. While some of it is prescribed by the company law boards, there could be instances where you could change the method of depreciation from return on to straight line or vice versa. Now, should that happen, then you would need to very clearly state why this has been done and since when has that been done. Or it could be things like making provision for bad debts. Let's assume that you sold 100 crores and you got back 80 crores and the balance 20 crores have actually turned bad. Then you need to write off those 20 crores from your profit and loss account. So these are just some of the examples, but the key takeaway from this slide is that accounting disclosures have to be very clearly articulated so that the users are very clear about what is the true financial status or true financial position of the company. So in terms of the significance, as we mentioned earlier, it provides reliable information to various stakeholders. It can provide a very meaningful comparison of financial statements of different companies, and for your own company, you could look at how the financial statements have moved over a period of time. It could be a 3-year time frame or a 5-year time frame. And based on the sort of disclosure that is made by the company, the investor and shareholder can take investment decisions. So that was just an introductory session to our main session in terms of why are financial statements important and why are disclosures from an accounting perspective important. Now comes the more relevant part for you in terms of construction of a balance sheet. As we mentioned, the balance sheet typically will have the liabilities and assets. The liability has to match the asset in terms of the quantum of rupees. So the typical heads under liabilities would be the owner's capital, which is the equity capital, the reserves and surpluses which come through your profit and loss account. The second segment in the liability is the borrowed funds. Borrowed funds typically could be either long-term or short-term debt. Long-term debts are those debts where the repayment of principal is beyond a year. Short-term debt typically would be those where the repayment is less than 1 year. So typically in long-term debt in the Indian context, you will find bonds, debentures, any long-term loans which typically are used by a company for its capital expenditure or expansion programs. Short-term debt typically would be your bank borrowings. It could be intercorporate borrowings from other corporates and any other short-term borrowings that banks might give. The third segment in the liabilities is the working capital, where typically the creditors for your raw materials or creditors for your machinery will feature there, and all other current liabilities and provisions. So it could be things like the provision for tax or provision for gratuity, provision for dividend. So all of those we find under the head of provisions. Anyway, we're going to be seeing some of these annual reports, so I think we'll get a little more clarity there. Now, coming on to the assets side, the assets, typically you have the fixed assets, so where the land and machinery, land and building and plant and machinery typically would feature there. You would also have the separate head called as investments. And here investments can be made either in shares of other companies, it could be made in shares of other group companies, or it could be made in bonds and debentures of other companies, or any government security that the company might want to invest. And thirdly is the working capital, where the various components would be raw material, work in progress, the finished goods, debtors or receivables, and cash. So in essence, the liabilities and assets have to match. That's why it's called as a balance sheet, in terms of how you match the assets and the liabilities. Now, if you look at what a liability means, and I think we sort of touched upon this earlier on also. Liability essentially means what are the various sources of funds which are available to the enterprise. And this liability, when we talk of liability, it is a liability of the company or the enterprise to the providers of these funds. So let's say if a bank has lent 50 crores to a company. For a company, the 50 crores is a liability which they have to repay to the bank over a period of time. Likewise, when you look at asset basically means the various uses of funds by an enterprise. And when you talk of assets, these are basically those which are essential for the company to be carrying out their business. And this could include both fixed assets and the current assets. So fixed assets would be office space, your factory, your land, building. The current assets would be raw material, inventory, and so on and so forth. Now, as I mentioned earlier, the assets and liability should always match. In the liability side, the one important concept is called as the capital structure of the company. It essentially is what is my mix of the funds that I bring on my own and also the reserves that I generate from the business to the borrowed funds. So that's essentially known as the capital structure. I think we will talk about those ratios in the next session. The other important concept is in terms of how do you mention what a balance sheet is. The balance sheet is always as of a particular date. So today we are on 26th of March 2013. So for a company, you can have a balance sheet as of today, or you can have a balance sheet at the end of every month, or every quarter, or every half year, or the full year. So it essentially means what is the static picture of the assets and liabilities as of a particular date. So it doesn't mean that the balance sheet can be made only on March 31, 2013. You can have a balance sheet at any point in time that you choose to cast. So another way of looking at the balance sheet is to match the sources and uses of funds. Now, what I'm explaining to you are different ways of looking at the balance sheet. So when you look at the liability side, the long-term sources are, when you talk of long-term sources, these are sources where the repayment happens much beyond 1 year. So the long-term sources would be equity capital, it could be reserves and surpluses, and the long-term borrowings. On the asset side, the long-term uses are the fixed assets, because the fixed assets would mean that you're going to have those assets for a fairly long time and use that to generate revenues for the company. The other long-term use could be investments, where you're expecting to keep the investments for beyond a year. The rest are all short-term on both sides. You have current assets on the asset side, you have current liability and the short-term debt on the liability side. Ideally, the long-term uses must always be funded with long-term funds. Now, the reason for that is if you're funding your long-term uses with short-term funds, then basically what happens is that you always have this risk of the interest rates changing, because your short-term funds will have to be repaid. Let's assume that you take a short-term fund of 9 months or 10 months. You have to repay that within 10 months. And again, if you want to borrow, maybe the interest rate would have just gone up. Let's say the initial time that you borrowed was 10, 11%. And after you repay that loan and you want to go for a fresh borrowing, then you might end up paying 12, 13%. So that is, in finance parlance, it's called as the refinancing risk or the interest rate risk. It is another parallel is to say that you have maybe put money into a 1-year deposit. It was at maybe 7%, whereas at the same time the 3-year deposit was, let's say, 12%. Now you took a call saying that the interest rates will go up over a point in time. So let me keep rolling over this 1-year deposit after every year. But when you find that the interest rate moves the other way around, let's say instead of you expecting it to go to 13% after 1 year, went down, then you actually end up losing money. So the interest rate risk or the refinancing risk is a very important concept that one needs to understand. So the long-term uses have to always be funded with the long-term sources of funds. Whereas any short-term investment can be funded through a combination of either long-term and short-term funds, and that essentially depends on the finance manager's perspective of a preference. So I thought rather than going through each of these, it might be useful to look at this caselet in terms of how to prepare a simple balance sheet. So these are basically balances of a company, a hypothetical company, ABC Limited, on 31/3/2011, and these are basically extracted from there. We're looking at what is the balance sheet as of 31st March 2012. So I'll just take you into an Excel sheet. Okay, essentially the various heads are given here. I think the first task is to figure out whether it's an asset or a liability before we actually try and balance the balance sheet. Share capital is a liability to the shareholder. So that's where, so it's a liability that we are showing here, which is 10 lakhs. Machinery, the plant and machinery is actually a fixed asset. So the plant and machinery is shown here as a fixed asset at 5 lakhs. Likewise, land is again a fixed asset. So you're showing land as a fixed asset of 8 lakhs. Bills receivable is something that you have to get the money from somebody else. So that's an asset, which is a current asset, which is shown here under the current asset. Building is again a fixed asset, which is shown at 2 lakhs. So building is at 2 lakhs. Cash in hand, cash is an asset, again a current asset, which is 50,000, shown under current asset. Debentures. Debenture, as I mentioned earlier on when we were talking of liability, debenture is a form of a long-term borrowing or a long-term loan. So it's shown here. Here I have not categorized as long-term, short-term, because the first time that we are doing to try to do the balance sheet preparation. Maybe when we go through one of those annual reports that I was talking about, maybe we can go through that in a little more detail. Sundry debtors is something that you have to again get from your customers. It is sometimes called as receivables also. So debtors are 1,50,000. bank loan is a short-term borrowing, so it is shown under the liabilities. Creditors again is something that you have to pay for raw materials or any other supplies that you might have contracted. So that is 1 lakh. When we talk of profit for current year and profit for previous year, these are essentially the reserves which are getting transferred from the profit and loss account onto the balance sheet. So profit for the previous year is, let's say, 1,50,000. Sorry, I think it should have been the other way around. The profit for the previous year was 2,50,000 and the profit for the current year was 1,50,000. So the total reserve is about 4 lakh rupees. And the provision for taxation, provision is something that you have to pay out. So that is a current liability, which is 50,000. So when you add up the numbers, the liabilities and the assets, you get 19 lakh of liabilities, which is matched by 19 lakh of assets. So just to go over it again, maybe you can try this out later on yourself. Let's take all the liability heads. As I mentioned, I think the key thing here, more than the number, is to know what goes where. So capital, share capital is a liability because that is something that you have to pay back to, as a company, to pay back to the shareholders. Profit, both the current year and the previous year, are reserves that you have actually generated as a company, and that again belongs to the shareholders. And the debentures are essentially a long-term borrowing, which is categorized as a liability. Bank loan again is a short-term borrowing or a short-term liability, which again you have to repay over a period of time. Then comes the current liabilities, which are the sundry creditors, which essentially mean that you get a credit period for the raw materials or any other supplies that you might have contracted, and which needs to be paid off in less than a year's time. That's why it's a current liability. And likewise, taxation, where again the liability has to be paid off in less than a year's time. So that totals up to 19 lakhs. On the asset side, we were provided data for various of the fixed assets, which included machinery, land, and building. So that totaled up to 15 lakhs. Normally, you would have, as we mentioned earlier, another item for investments. In this example, since there are no investments, we are not showing that separately. You also have the current assets, which could be cash, it could be bills that you have to receive. It could also be other debtors that you have to collect. So it totals up to 19 lakhs. The balance sheet is also balanced. So that was the balance sheet. Now comes the construct of a profit and loss account. Now you have the revenues from the business, and here we're going to be taking off all the expenses, which could be raw materials, it could be employee expenses, it could be other manufacturing expenses. You could have expenses relating to spares. There could be fuel expenses, administrative expenses, selling expenses. So all these are the cost of sales. So the revenue minus the cost of sales would give you the EBITDA, which is the earnings before interest, tax, depreciation, and amortization. So from this, when you subtract the depreciation, which is a non-cash item, you get the profit or earnings before interest and tax. And from that, you subtract the interest payment, you get profit before tax. Further, if you subtract taxes, you get profit after tax. And then when you subtract the dividend from profit after tax, you get the retained earnings or the reserve, which go back to the company's kitty and is shown in the balance sheet as a reserve item. So just to summarize here, the various levels of profit would be the EBITDA, which is the earnings before interest, tax, depreciation, amortization, the profit before interest and tax, the profit before tax, and the profit after tax. And ultimately, you get the accretion to reserves after you paid off the dividend. So inside the profit and loss account, the typical items under revenue from business would be, typically you will find that the typical revenue from business would be the sales revenue and the other related income. When we talk about other related income, it means any income which is relating to the operations of the company. Now, typically it could be, let's say that you're an automotive company, you will generate a lot of scrap, and you're going to be selling that scrap. So that is actually related to the operations that you do. Or you might be exporting certain products outside, for which you get some duty drawback, which is returned to you. So that's another source of other related income. So these are essentially revenues from business. There could be non-operating income which has nothing to do with your operations as an auto component manufacturer or any other activity that you undertake. So this could arise because of investments that you make elsewhere, either in the form of dividends or interest. Or you might have leased off a facility to another third party on which you get some amount of rent. So these are all called as non-operating income. There is a third category which is called as the extraordinary income. You could also have an extraordinary expense. The extraordinary income could be, when you talk of extraordinary, it means that it doesn't happen every other day or every other month. This happens once in a while. So it could be that you've generated certain amount of profit because you sold off some assets or sold off some investments. Or there could be some adjustments which are pertaining to the earlier year, which are called as these prior period adjustments. You could also have extraordinary expense. One of the good examples of extraordinary expense could be one, you could have a voluntary retirement scheme for your employees, which is not something that you do every year. So that will feature under the extraordinary expense. Or on some foreign exchange transactions, you might incur a loss. You can also incur a gain on foreign exchange transactions. So that would get categorized under the extraordinary expense. So typically under cost of sales, there are three different heads under which you can group them under. One is the cost of goods sold. I think we talked about gross margin, gross profit, maybe in a very brief manner the last session. When you talk of cost of goods sold, it basically means what are all the direct costs that are involved in manufacturing my product, which will involve both the material cost and also the direct labor cost and any other direct manufacturing overheads. So that's called as a cost of goods sold. The second broad category of costs are the administrative costs, which can be office rent, it can be salaries, it can be your telecommunication costs, and it can also be any other costs that you might incur, which can be grouped under the administrative costs. The third is the selling and distribution costs. And here you will have salaries of sales staff, for instance, which will come under selling and distribution costs. Any promotional expense or brand promotion expenses that you might undertake to sell your product. Or you might be giving commission to your agents or dealers. Or you might be incurring certain advertisement expenses for your brand building activities. So all of these will feature under the selling and distribution costs. Depreciation You could have straight line method or return on value method. I think we've already touched upon this. The other sort of heading that you could have is a deferred revenue expenditure, where typically you would find R&D expenses, advertisement expenditure, or product promotion expenses, which are typically charged as capital expenditure, which is amortized over a period of time. The reason being, for instance, we are going on a brand promotion activity. Now the returns from the brand promotion activity will not come in the immediate year. It will happen over a period of time. So let's say you're a new company and you're starting off from scratch and you're incurring a huge brand promotion activity. Your initial years of sales will not be in proportion to the sort of expenditure that you make. So you're trying to defer that expenditure over a period of time in tandem with the expected growth in sales or revenue for your business. So these are all deferred revenue expenditure. Now if you look at the profit and loss account, it essentially gives you a snapshot picture of the financial performance of a company over a given period. It can be over a year, it can be a half year, it can be a quarter. So typically when you talk of profit and loss account, it is for a particular period. It can be 6 months, 9 months, 12 months or 3 months. So it is a flow item. It is not a static item like a balance sheet. Now it provides great insights into the company's operations. One is you can get to know what are the fixed costs and what are the variable costs, and therefore know what is the break-even point at which there is no loss or no gain for the company. And all companies have to compute what is their break-even point or break-even capacity. It is important for everybody to know that number, because that is the point at which you are neither making money or making any loss. Many times I've heard that people have said that we are not able to compute the break-even point because we make so many different products, and how do we calculate the break-even point for each product? It is possible to do that. You can use certain surrogates such as capacity utilization of a particular plant, or you could use surrogates such as machine utilization. How often has my machine been utilized? Has it been 100%, 80%, 90%, and so on and so forth? You can also get an idea of what are the cash expenses versus non-cash expenses. Depreciation is typically the only non-cash expenses, and you can also make an analysis of which are your key expenses amongst the expenses that we looked at, whether it's raw material, whether it's selling, whether it's power and fuel or administration expense. And also you can get a break up between the recurring income and the one-time income. Your normal activity typically would be a recurring income, and as I mentioned earlier, extraordinary income and extraordinary expenses are typically one-time in nature, like the VRS schemes or sale of a factory unit or disposal of some of the assets. The other key point that you need to make and need to know is net profits do not repay loans. It is only cash that can repay the loans, because it is possible that much of your sales might actually be in the form of debtors. So you always need to look at the cash flow analysis in a great amount of detail. There are a couple of case lists. Anyway, I'll go back to the Excel sheet here. Okay, the question here is, before we go to the solution, is calculate EBITDA, profit before tax and profit after tax. Now the data that is given to you are one, the revenue, which is 1,000 crores, the cost of goods sold, which essentially is the direct material, direct labor, and the other overheads, which is 500. The administrative costs are 100 crores. Selling and distribution costs are 150. There's other income of 150 crores and tax of 200 crores. So you have to calculate what is EBITDA, what is the profit before tax, and what is the profit after tax. So revenue of 1,000, basically I've just put these figures back in a logical order. So the revenue shown as 1,000 crores. All the other expense heads are highlighted in red, which is cost of goods sold of 500 crores, administrative costs of 100 crores, selling and distribution of 150 crores. So together they will make up for 750 crores. So EBITDA is revenue minus all your costs, so which is 1000 minus 250. Sorry, 1000 minus 750, which will give you 250. The company has some other income. The other income could be dividend, it could be interest on some of the investments that they have made in fixed deposits. So that's shown as 150. So the profit before tax is the EBITDA plus the other income, which is 250 plus 150, which is 400. There is tax of outflow of 200, and therefore the profit before tax minus tax gives the profit after tax, which is also 200. So there are three levels of profits that we have calculated. One is the operating profit, which is EBITDA. The other is the profit at the pre-tax level, which is the profit before tax. And lastly, it is the profit after tax, which is after the company has paid out the tax. So that was a quick example of what the profit and loss statement at various levels of profit are. Now, as I mentioned in the first few opening slides, this cash flow statement is an ancillary statement, and it basically is derived from the profit and loss statement and the balance sheet. Now, basically, there are three different components to the cash flow statement. One is the cash flow from the operating activities. It's basically what is the cash that I am generating from my operations, which basically is the measure of cash profit for the company. The other is what is the cash flow in investing activities. See, in all these cases, you can have either a positive or a negative, so there is no standard rule. It depends on how much of the outflow is there and how much of the inflow is there. The second is cash flow in investing activities. So when you talk about investing, it can be deployment in various assets such as fixed assets or investments. The third is cash flow from financing activities, where I'm trying to look at my net cash after I raise money in the form of capital such as equity or from borrowings. I will also, as a company, be repaying some of these loans. So in effect, when you look at the cash flow from financing activities, it is the net impact of the inflows and outflows. So essentially this segregates what is the cash generated and what is the cash that I've used. And end of the year, find out whether the company has generated cash or has drained out cash from the system. So essentially when you look at the cash flow from operating activities, it essentially is you have your profit before tax, you subtract the non-operating income. Here you subtract the non-operating income because it has nothing to do with the day-to-day operations of the company. Then you add back interest, you add back the depreciation, because depreciation is a non-cash item. Then you subtract any of the other cash adjustments that you typically would make. So these are the operating profit before working capital changes. And then you also need to adjust for all the working capital items which are there, which could be debtors, inventory, other current assets, creditors, current liabilities and provisions. Here, whether it's positive or negative would depend on what sort of action has happened on each of these heads. For instance, if there has been an increase in debtors, what does it mean? It means that you have not been able to collect that amount which is reflected as debtors, which means that the cash has not come into the system. So you give a negative effect to that. Likewise, when you talk of increase in creditors, it means that you managed to get credit as a company from the supplier, where you didn't have to pay the money immediately on the supplies reaching your factory site. You got 30 to 40 days of credit. So which means that you actually retain cash in the system, and therefore you give a positive effect to that. So that positive and negative effect will depend in terms of whether there's been an increase or decrease in any of these current liabilities or current assets. So that is the cash generated from the operations. Now after that you subtract the tax and then you get the net cash from the operating activities. So to summarize, you get the profit before tax, remove all the non-operating income, add back the interest, because the effect of interest etc. we will take in the financing activity. Then you have the operating profit before working capital changes. Then you give effect to the various working capital elements, either as a positive or a negative, depending on whether it's increased or decreased. And then subtract taxes and you get the net cash from the operating activities. Likewise, investing activities, again very similar principle. You will purchase fixed assets. You could purchase long-term assets or long-term investments. But you might be having a negative effect when you actually try and make a payment for the asset that you buy, because you're actually paying money out of the system, and therefore the cash effect actually comes down. At the same time, in the investing activity, if you're actually getting dividends or interest, cash is coming into the system. So like we saw in the operating activity, the effect of cash going in and cash coming out will have to be given for each of the activities under the investing activities. A similar way for the financing activity. For instance, when you actually get money from your shareholders, it is cash coming into the system. Or when you're borrowing from somebody else, it is actually cash coming into the system. At the same time, when you're going to be repaying your interest or paying out dividends to the shareholders, it is cash going out of the system. So it is a negative effect. And then you take a positive and a negative impact of that and see whether the cash flow from the financing activity is a positive or a negative. Then what you do is you add, depending on the signs of each of these, the operating activity, the investment activity, and the financing activity are all added, whatever the balances are, whether it is plus or a minus, and then you arrive at the final balance of what cash was generated or drained out of my company during the current year. And then you either add or subtract that to the opening balance. Let's assume that when you started off the year, you had 50 crores of cash. And now there is only 5 crores of cash left in the bank. It means that at the end of all these things that you have done during the year, you have drained out 45 crores of cash from the company. And that is why the 50 minus 45 will give you only 5 crores of cash which is there in your bank account. So the cash flow statement basically tells you where is the cash coming in, where have you lost the cash, where has the cash come in which of these activities, and helps you very clearly segregate why the company's cash position has improved or worsened during the financial year. So in terms of what are the observations in cash flow, I think the role that all of you need to envisage is to interpret some of these numbers or findings from each of these statements. Now, for instance, the cash flow statement actually gives you a good idea of what the quality of the profits are. For instance, the company shows a sale of reports profits, let's say of 100 crores, and 80 crores were actually in the form of receivables or collectibles, it means that much of the sales that they have done is locked up in receivables, which does not reflect a very good cash position. It means that the analyst or the bank will start probing in terms of what the balance amount of receivables or debtors are, and whether that money will come back or not to the company. And the other important point is it provides a big picture in terms of where the cash comes in and where the cash goes out. Now let's assume that disproportionate amount of cash is going into some investment activity which is not yielding returns. It means that the company has to stop making these investments in that particular activity. It could be some particular business that they are looking at, or some particular division of the company where a lot of investment is being made, but there are no returns which are coming back to the company. So cash flow statement will be able to give a clear and good idea of that. The third point is a cash flow statement, and these days everything is computerized. So typically this checking is something which will happen automatically. The cash flow statement at the end of it provides you what is the closing cash balance, and that closing cash balance has to actually tie up with the bank balance amount. Let's say the closing cash balance here was shown as 5 crores. You should physically have 5 crores in your company's bank account. The other important conclusion that one can draw is, if there is, let's say, negative cash flow from operations, you should not panic and assume that the company is going through a stressful period. Negative cash flow from operations can happen when a company is typically in a growth phase, or when the company's working capital requirements are fairly large. What happens in any company, typically you'll find that the last couple of quarters are typically where you're trying to push sales, and where the activity is a little heightened and there will be a lot of demand for working capital. You might push sales, but you may not be collecting it, or you may not be getting enough money on credit. You might have to pay them upfront and get your raw materials. So all this can actually lead to negative cash flow from operations. So one must immediately not conclude that the company is in distress and might suddenly collapse. You have to go into each of those elements of the cash flow to understand why the negativity has arisen, and then decide whether it was because of an actual problem in the company, or whether it was a temporary problem because of the sudden spurt in working capital requirement. So typically you find that negative cash flow from operation is a sign of a growing company which is trying to have a heightened activity of operations. So just to give you a small caselet on cash flows. Basically here the task is to classify the following elements that you will find in a cash flow statement on whether it is non-cash. The key word is non-cash. Just as we said, depreciation is non-cash, because there is no, I think that's one of the questions here too. So that was just to help you out. Depreciation is a non-cash item because there is no cash moving in or out. The question is, like depreciation, which is a non-cash, which are the investing, financing and operating activities which are non-cash? The first is redemption of debentures by converting into equity shares. Firstly, it is a financing activity. Is there any cash outflow or inflow? The answer is no, because you are just converting your existing debentures into equity shares. The point number 2, buyback of equity shares. The first question to ask is it cash or non-cash? When you talk of buyback, it means that the company is buying back shares from its shareholders by paying X amount of rupees. So it is a non-cash, it is a cash item and it's not a non-cash item. The third is purchase of fixed assets in exchange for preference shares. Again here, firstly it is a non-cash item because there is no movement of cash or transaction of cash. You are just exchanging the preference share. Preference share, as I mentioned, is also a form of borrowing. I think we discussed that in the last session. So you're just exchanging the preference shares for fixed assets and showing it as a non-cash investment activity. I think depreciation we have already shown. Depreciation is a non-cash operations. Increase in debtors is a cash or non-cash? Obviously it is a cash item. Likewise, decrease of inventories again is a cash item. There is nothing non-cash about it. Amortization of patents, again it is a non-cash operating activity. Loss and sale of plant, again is a non-cash. You have sold something, you incurred a loss, so the balance sheet will have, there will be a loss which is shown there. So it will be reflecting as a non-cash operating activity. Issuance of equity share for cash. Obviously, I think the question itself tells you that it's a cash item and not a non-cash item. The last is bonus shares. Bonus shares essentially mean that for every share that you own, the company at various points in time, depending on their reserve position, might give you an extra share. When you talk of 1:1 bonus share, it means that for every share that you own, the company gives you one share which is free of cost. So typically it's a non-cash financing activity. So these broadly tells you, what is a cash item and what is a non-cash item. Now comes another small caselet in terms of trying to understand how to calculate cash from the investing activities and financing activities from a list of data that is given to you. The question here is, you have the opening cash balance, which is 20,000. All these are in Indian rupees. The closing cash balance at the end of the year has been given to you already, which is 25,000. Decreasing debtors, which is shown as 8,000. Increasing creditors is 10,000. Sale of fixed assets is 50,000. Redemption of debentures is 22,000. Dividend paid is 68,000, and net profit for the year is 27,000. So the starting point is you're given the opening cash balance is 20,000, which means initially when you started off the year, the bank had 20,000 of cash. The closing cash balance is also given to you, which is 25,000. So it means, what does it mean? It means that your cash that you have generated during the year has been 5,000, which is 25,000 minus 20,000, which gives you 5,000. Or the 5,000 is a combination of the cash that you have generated from your operations, investing activity and the financing activity. So when you look at the cash from operations, 27,000, which is the net profit for the year, will reflect under the operations as plus 27,000, which is shown here. When you talk of decreasing debtors, it means that if debtors have increased from one point in time to another point in time, it means that money or cash has come into the system. So we give a positive effect to that. When you talk of increasing creditors, it again means that you have paid off your suppliers only after the point in time, after you enjoyed the credit period, which essentially means that you have retained cash in the system, which is therefore you're giving a positive effect to that, which is plus 10,000. So effectively, the cash flow from operation is 45,000, which is 27,000 plus 8,000 plus 10,000. So that is 45,000. If you look at cash from investments, you've sold fixed assets and therefore you've got 50,000, which is cash which has come into the system. So there is only one entry here from the list of entries that we have. And from financing, redemption of debentures. When you talk of redemption, it means you have repaid the debenture of worth 22,000 rupees or crores rupees with you. So 22,000 has been repaid to the issuer of the debenture or the person who is, or the company who has lent that amount to you. dividend paid is 68,000, which is dividend which has been paid off to the shareholders. So here you get minus 90,000. So the cash from operation is 45,000. The cash from investments is 50,000. The cash from financing activity is a negative or a minus 90,000. So the cash generated is a summation of all of these, which is 45,000 plus 50,000, which is 95,000, minus 90,000 is 50, which is 5,000. Which again is substantiated by the fact that the closing balance is 25,000, which is already given. So you have 20,000 of opening cash balance and 5,000 of cash that you have generated. So the closing cash balance in your bank is 25,000. You also have another statement, which is the funds flow statement. So funds flow statement basically is a summary of the inflow and outflow of funds, which essentially shows you what are your long-term sources of funds, what are your short-term sources of funds, what are your long-term, uses of funds and short-term uses of funds. Basically, the funds flow statement will be able to tell you is there a mismatch in the sources and uses of funds. Are short-term funds being used to finance your long-term assets, like your fixed assets? And how can the company correct that over a period of time? So the preparation of the fund flow statement will enable the company to take important decisions in terms of both the financing activity and also the sort of assets that they would like to invest or finance over a period of time. So a typical funds flow statement will be sources of funds. The sources of funds will be the cash from your own business, the long-term funds through either debt or equity, or you could have the bank borrowings, which typically are used to increase the working capital, and you can also generate funds through sale of investments or sale of the assets. Where will you use this money? The money can be used for various activities. Or maybe the word that I should use is funds. Where will you use these funds? These funds can be used for, one, to repay your debt, because every year you might be having to repay your borrowings. So part of the funds can go in for repaying your debt. Part of it can be used for your anticipated increase in working capital because of an increase in activity in your company. The third is for planned capital expenditure and investments. There's certain expenditure that you would have planned during the year, so you use it for that. Now when you talk of capital expenditure, some companies or some industries have the flexibility in deferring the capital expenditure. For instance, you might have planned a capital expenditure of 1,500 crores. Now, depending on whether it is modular or bulky, you can decide whether that will happen or not happen in the current year. When you talk of modular or bulky, what does it mean? When you talk of bulky, it means that once you started the capital expenditure, you have to incur the entire capital expenditure, which is what is bulky. For instance, a cement plant, you have decided to go for an expansion. Once you start, you have to incur all of it to complete the entire chain of activities for manufacturing the cement. So that is the bulky. Or chemical industries or process industries, where once you start capital expenditure, you need to go through the entire stream of machinery required to manufacture that chemical. When you talk of modular capex, it means that I can wait and watch and do it in a modular fashion. I don't have to incur the entire 1,500 crores upfront. I can do it over a period of time. A good example would be the cellular sites that we are seeing, the mobile towers that we are seeing. What companies typically will do is, let's assume that they are tapping a new area in some part of the city. They will not put up the entire capital expenditure of 1,500 crores across all the nook and corner of that city. They will put it in a few sites to see how the response is. Once that is all right, they will start incurring the capital expenditure in a phased sort of manner or a modular sort of manner. So that is the difference between modular and bulky or continuous capital expenditure. So the fund flow statement will enable you to plan out your capital expenditure depending on how the activity will span out. So I think what we have covered so far, just to give you in a nutshell, is basically what we've done in the first session is to look at what is the financial statement, what is the essence of it, what are the uses of it, some broad overview in terms of why accounting is important and why disclosures particularly are important. Then we touched upon the various elements in the balance sheet in terms of trying to know what is a liability, what is an asset, what are the various elements that constitute the liability or the asset, and also looked at the profit and loss statement in terms of what are the various elements there in the cash flow statement, and also some caselets in terms of trying to give you an overview or an understanding of how some of these are actually calculated. Now, since most of you would be from the non-finance stream, you're not expected to sit down and cast the balance sheet. I think the main role that you're expected to play is to interpret the balance sheet and profit and loss account from a operations perspective or a business perspective and understand what is happening in the company and how you can improve upon that. So what I'll do now is take you through one of the annual reports. I've just taken TVS Sri Chakra. I think we could have taken anything. Basically to show you what is there in the annual report and what are things that you need to monitor or look at when you look at your own company's annual report. These are all available on the website. So I think maybe once the session is over, I think you can go back home and maybe visit the website and maybe go through some of it that we have seen. So essentially, you'll find that it starts off with a list of the board of directors in terms of who's there on the board. Things like the audit committee, who's there, the investors committee, the plant location, who are the auditors of the company, who are the bankers, registrars, where is the registered office, and so on and so forth. This is basically notice given to the shareholders in terms of when this whole annual general meeting is going to happen. I'm skipping some of those. Okay, this is important for you. This basically gives you a 5-year performance at a glance. Tells you what is the gross income, what is the retained profit, the various elements of profitability. In a snapshot, it also gives you what is the liability and what is the asset. Anyway, the details are there in the other parts of the annual report. Also, some of the ratios here. So the right-handmost column is the current year, 2010-11, and the furthermost is the earlier year. So from this, I think by now you should be able to interpret this. Now, one of the ratios here we are looking at is EBITDA, profit before depreciation, interest and tax, to net sales. So had we been face to face, I would have asked you this question, but looking at it here, that number was 5.86, beginning of that time frame that we are looking at. Currently it is 8.36, which means that over a period of time, the performance of the company is also improved. Let's look at another ratio, which is debt equity ratio, which is my capital structure ratio. This is my total debt or total borrowings to the net worth of the shareholders' capital. What can one conclude from this? what you can conclude from this is a company which has traditionally borrowed quite high or quite heavily. Because anything over 2 times is a very high level of borrowing, because you borrowed 2 times your own funds, which means that if there is a downturn or a recession or difficulty, then it could become difficult for companies to generate cash to repay the interest and principal obligation. Anyway, our next session is on ratio analysis. So I guess once you finish with that, you can always come back, visit this website, download this, and maybe understand and read this a lot easier. So this is the financial highlights that they present. So they basically give you what is the net profit. I think these are the appropriation that we talked about, the transfer to reserves and what those numbers are and how much is carried back to the balance sheet. This basically shows how the revenues have been split. Basically an idea of what are the revenues over a 5-year time frame. So these are basically various graphs on various of these parameters. This gives you a graphic presentation of the operating margins. Then there is a summary in terms of how the domestic market was and how the overseas market was. Where they give their commentary in terms of why the company performed the way they performed, depending on the market conditions. Then they also talk of the export market, what expansion did they do in their factory. So remember, we had talked about various accounting standards. So in terms of accounting standard 21, which is what this company has followed, which is what has been prescribed by the institute. So they have consolidated the subsidiaries accounts, which is what I mentioned earlier on, with that of the parent company. Then there is a corporate governance, which is actually what they have to disclose if they are a listed company. Under this clause 49, they are supposed to disclose their corporate governance activities. And this is basically from the operations side. What is their power and fuel consumption, how have they conserved energy, what measures they have taken. This is in terms of R&D efforts. How much have they spent on R&D? I think this is a very important indicator. Maybe in this company it is not so much, it's just less than a percentage. But some of the other companies, for instance, you look at pharmaceutical companies or you look at other technologically intensive companies, you'll find that the R&D expenditures can be pretty high, and as a percentage of the sales can be a fairly large sort of number. This is the management discussion in terms of what the industry structure is. This is the management's perspective. And this gives a fairly good insight in terms of the activities of the company, the industry scenario, all from a management's perspective. What have they done in the marketplace, both in the OEM market and the replacement market? How have they managed the manufacturing activity? How have they controlled curtailed costs? And what is the outlook for business? This is a very important statement in the management. I think one thing that all of you should do is when you get back, since I know there are almost about 30 or 35 people who are continuing from the earlier session. Now, once we finish with today's session, what I would urge all of you, for you to complete the learning. Obviously, there are 2 more webinars, one on costing, budgeting, and investment decisions. I think what all of you should do is to slowly start trying to apply this in your day-to-day activity. Maybe you can spend half an hour or 1 hour watching any of these financial news on TV. And I think there are these half an hour and 1 hour capsules that you get at night. So you can just spend there so that you get more familiar with these terms and maybe read some of these financial dailies where they talk a lot about these. The reason why I'm requesting all of you to do it is only then will you find that you're able to apply this onto your day-to-day job. Now, if you calculate some of these ratios for your competitors, then you'll get to know where they are scoring or where they are underperforming vis-a-vis you. But there are a lot of reports that you can also outsource, a lot of reports on companies that you can get. And there, once you're familiar with this, then you will be able to understand and appreciate some of these financial conclusions or analysis that many of these companies are doing. So that's something that you might want to do. I think here they also outline what are the opportunities and threats, what are the various risks and concerns of the company. And again, they're talking about, both the external risk and the internal risk. I'm not going through each of these commentaries. I'm just broadly trying to tell you what are the various things that are present in the annual report. This again is what are the internal control systems that are put in place in this company, and what is the discussion on financial performance. For instance, here where I'm just showing you the point, what they have said is the volatility in the prices of rubber has actually impacted the company's performance. So they have actually affected some price corrections in the marketplace. So this is corporate governance, which basically tells you who are the board of directors, how many board meetings they have attended, are they members of other boards, and so on and so forth. So this is basically a standard format which they go through. These are the salary details of the managing director and chairman in terms of salaries, commission, perks, etc. Okay. Now this gives you an idea of what is the shareholding distribution of the company in terms of how many people have shares of more than 10,001 and above, and so on and so forth. These are the share price data in terms of how the share prices have moved over a point in time. The graphic representation of that. This basically is what we did in the first session in terms of the balance sheet, shares, capital, reserves and surplus, what are secured loans, what are unsecured loans, what are the asset side, fixed assets, the gross block, investments, current assets. Current liability is presented here in this way. That's the way that as per the guidelines they will present. And what are the numbers which they are tagging. So each of it has a schedule. So inventories, for instance, will have a schedule which has standard schedules in terms of what items you'll find there. We'll go through some of those schedules there, maybe not all of it. The income statement is what I mentioned to you. So this is a standard way of presenting it. So you have income, which is the sales less excise duty, then there is increase or decrease in stock, various expenditure, you have interest, depreciation, profit before tax, profit after tax, transfers to reserves, and so on and so forth. We'll just take through some of these things. I think the easier one to take would be inventories, for instance. So inventories will be further broken down into raw material at cost, what is the work in progress at cost, what is finished goods. But when you talk of here, if you recollect in the slide on accounting, I talked about valuation of assets is very important for the user of the annual report. So here you're very clear. Finished goods is valued at lower of the cost and the realizable value. So the user knows that this is how the valuation has happened. Now, if you look at another important item in the balance sheet, which are the debtors. So basically it says that the other debts are 173 crores and 173 crores. The debtors which are outstanding for a period more than 6 months is only 83 lakhs. So immediately you can draw to a conclusion. This has been relating to the sales, that the debtors over 6 months is not a very alarming number for this company. That's a first cut analysis that you can make by just looking at these numbers. Likewise, for instance, provision. Provision is a current liability. You make a provision for dividend, you have to pay off the dividend. There's a dividend tax that you have to pay off. Provision for employees gratuity. Also, it is a current liability. Leave encashment, again, is a current liability. You cannot tell employees to encash their leave and pay them after 2 years or 3 years. It has to be prepaid immediately. Now, likewise, on the profit and loss account, there is another income, which could be rent, it could be interest, it could be dividend. I was talking to you about foreign exchange fluctuation. If it has a positive impact on the company, then it becomes an income. Expenses, the various categories here. Stores, salaries, there could be contribution to provident fund. So that list is the entire set of expenses that we discussed. These are the various schedules. These are the accounting policies. I think we talked about some of it. I'm not going through each of these in detail. It basically shows that the company has followed the standard accounting policies as detailed out by the institute guidelines on various activities. So these are the various accounting standards that they have followed right up to that. This gives you certain information in terms of the capacities in the company. The license capacity is so much, the installed capacity is so much. These are my opening and closing stock. These are the various production activities. These are the sales of tires. These are sales of tubes. You know what is the quantity of tires that have been sold, what is the quantity of tubes that have been sold, what price they have been sold. And you will also know from this, you can also compute what is the unit realization of each tire or each tube. Likewise, you've also bought and sold some tires and flaps. That is a traded good purchase and sales. This is important in terms of the raw material consumed. So you'll get to know what is the quantum of raw material that I have purchased, at what price have I purchased, how has it been in relation to the earlier year. So one of the objectives that we talked about in financial statement is comparability across different years for that same company. So likewise, if you do a 5-year comparison, you will get to know that. This again is what has this company done on the R&D expenditure. So that breakup is given here. This is the sources and uses of funds that we talked about. These are the sources. Where have they used those funds? So they have capital, they have surplus, various loans. How much have they deployed in fixed assets? How much have they done in investments? There's something called as contingent liability. Contingent liability means those are liabilities which would have to be paid off by the company should some event happen, which is what it means, that contingent on some event happening, the company might have to pay off that liability. For instance, there could be excise duty under dispute. Some excise duty which is under dispute, which the company might have to repay if there is a problem with it and the court rules against the company. Or letters of credit opened by the company's bankers. So they're basically opened by, when they're purchasing some capital goods item or any such item, the banks will open a letter of credit for them because the counterparty will want to make sure that they will get their money. So this is something which is outstanding as of the particular balance sheet, which should, there be a problem, then the company will have to end up paying that amount. The other important thing is the disclosure on related party transaction. When you talk of related party, it could be any party which is closely associated with the company, either as a group company or an associate company, or where there is commonality of directors or board members. So essentially they outline various activities. For instance, you'll find that some sale of some 74 crores has happened to the associate company. This is the cash flow statement. I think we're coming to the end of it, where again divided into cash flow from operations, just as a way that we had presented it. You get the operating profit before working capital changes. Then you adjust for all the working capital elements, and you get the cash flow from operations, subtract the tax, and you get the net cash flow. Likewise, you look at the net cash flow from various investment activities in terms of fixed asset purchase, dividend received, investments made, investments sold, and you compute again the net cash flow from the financing activities. So the net increase or decreases, the company's cash position, I think what we can say is there has been a negative 3.45 crores of cash during the year. And from this you can find out what is the reason for it. The reason for that is largely because of the cash flow for investment activities, where the company has invested almost 65 crores in new assets. And that has caused an overall impact of a negative 3.45 crores in the reduction of cash. So the opening cash balance was 8.58 crores here. The closing cash balance is 5.13 because 3.45 is the negative impact on the opening balance. So here what we are seeing here is these are all consolidated financial statements, essentially consolidating with the subsidiary company. So what I would request you to do is, and I think looking at this might give you a lot more familiarity than just looking at those slides. I think what you should do is at the end of the day, please have a look. It can be this annual report or any of the annual reports for you to get a little more familiar with the terminologies that we are going through in today's session. And the key is to try and calculate some of these ratios yourself and try and interpret how the company is doing. Are they doing well? Is there a problem with the company? And you should also be able to link up the balance sheet with the profit and loss account and the cash flow statement. I think that's something that you will get with a lot more of looking into various annual reports of various companies. So we're done with the first part of the presentation. The second part of today's session is on ratio analysis and interpretation. Now, many of you might ask, why should we look at ratios and what are we trying to look at by looking at these ratios? Now, as all of you would know, that your ratio is a relationship which is a meaningful relationship between two financial parameters. Now here you can have, since we have a profit and loss account, you have the balance sheet and the cash flow. A ratio can be a combination of any of these two items from any of these three available statements that we have. Now the idea is not to look at some 100 or 200 ratios and say that okay, we have been able to generate the ratio. The idea is to look at meaningful ratios for understanding the financial position of the company and also try and find out how operationally efficient the company is. And you can find that out by looking at certain set of ratios and use that to effect changes in your company's operations, both from the manufacturing side as also on the marketing or the business side. And there is no standard set of ratios which will work for one company. For a particular company, a certain set of ratios will make sense. For some other company, some other set of ratios might make more sense. So that is something that you have to use judgment, and that will happen over a period of time as you keep looking at more and more of these companies. And ratio cannot be looked in isolation. You have to either have historical data for the company that we look at. For instance, when we looked at this TVS Sri Chakra, for instance, you cannot look at 1 year's performance and say whether the company is good or bad. You will just get an overall indicator. You have to look at how the company has done over a point in time. be a 3-year or a 5-year analysis. So that is one way of looking at it. Now the typical way of looking at it is something called as a 5 plus, 1 plus 3. Essentially, you look at 5 years of the past, the current year, and when you do the projections, you typically will do for a 3-year projection because the banks and lenders will look at that. The reason why you're looking at a 5-year sort of analysis of the past is essentially to factor in the ups and downs that the company might face in its business. Now, typically, if you look at it now, things are all maybe trying to emerge out of a downturn. Now, if you look at a company now and you look at a company maybe 5 years before, the numbers will be quite different. Because 5 years back, the company might have been doing very well because the economy was doing well and there was a great demand and there were no problems in terms of offtake. But if you have to look at how companies will perform in a steady state manner, you need to look at a time frame which will cover both the ups and downs in the company's performance. So that is what you mean by historical data. The second way of looking at it is to look at the company's performance vis-a-vis that of the competitors. Essentially, in all aspects, whether it can be profits, it can be the way the funding has been done for the company, the way the capital structure is for this company vis-a-vis the competitors. So on a variety of parameters, you can do it. And the reason that one needs to do that is to effect changes in your way of doing your business. So we look at it, we look at some of these ratios as we move on. The third is the industry norms. For instance, there could be an industry norm which will say that for the power sector, maybe the debt equity can be close to 4:1 when they start off. So that can be a norm. Or maybe shipping companies, the debt equity is a fairly large number. Or the other industry norm would be that EBITDA margins for mobile telephone operators is ranging between 35 to 40%. So somebody or some operator or some companies falling way below that, it means that it is way off from the industry norm, and therefore you need to take certain corrective actions to improve or perk up your margins. So ratios cannot be looked in isolation, they need to be compared with some yardstick, and these are the 3 yardsticks that one could look at. For instance, you can I'll just put this on for a couple of minutes. Now there are 2 companies, A and B, one with the sales of 200 crores, the other the sales of 180 crores, profit after tax of 28 crores, profit after tax of 19 crores. Now if I were to ask you to interpret this, okay, we also have this alongside. Purely from a profit and loss point of view, how do you interpret this will be my question. Ideally, one should look at profit and loss and balance sheet and everything, but since it's just a caselet for understanding, assuming that we just look at the profit and loss statement, maybe you can just write it down there. See the various interpretations you can make. I think somebody would say that the revenues were more for A versus B. But you can calculate a host of ratios here. You can calculate EBITDA, for instance, and look at it as a percentage of sales. You can look at profit after tax as a percentage of sales. So you might find that the profit after tax of company A as a percentage of sales is more than that of company B, for instance. So various interpretations can be made from this. Likewise, when you look at balance sheet here of 2 companies, A and B, you can calculate the capital structure. For instance, the bank borrowings or the borrowings of company B is 85 crores. Borrowings of company A is 65 crores. The net worth, which is the capital structure for both the capital plus the reserve, which is the net worth, is 60 crores for both the companies. Which is one interpretation you can make as the leveraging or gearing that we will be talking about, which is the total borrowings to the net worth of the company is more for company B versus company A. Anyway, it's a little premature for you to be calculating all the ratios, but the point is, given a balance sheet and a profit and loss statement, you can either compare company's profitability, or you can have a comparison of how the capital structure is, or you can compute those ratios where there is both a profit and loss element as also a balance sheet element. So broadly, if you look at it, there are 6 or 7 broad headings of ratios that you can look at. One is the profitability ratio. The other is the turnover ratio. Turnover meaning anything which is related to the sales of the company. The third is a capital structure ratio, which basically tells you how much of borrowing in relation to the company's own funds. What is the sort of borrowing that a company has? The fourth is the liquidity ratio in terms of trying to understand how liquid or illiquid the company is. Fifth is the earnings ratios, which typically tells you what is the earning potential of each of these companies. The sixth ratio is the return on investment, which essentially tells you for certain amounts of investment that either equity holder is making or equity and debt holders are making, what are the sort of returns or profits that are being generated by the company. The last are certain set of valuation ratios which are typically being used by various investors and prospective buyers of these companies. So if you look at profitability ratio, I think some of it we've already covered. The operating margin that we talked about is typically the EBITDA to the operating income. Now, the operating margin typically for healthy companies varies between 15% to 50%, and that depends on industry and depends on company to company. Likewise, the net profit margin would mean the profit after tax to the overall operating income. Again, here there is no standard benchmark, but typically for healthy companies, you will find that the range of net profit margin varies between 3% to 12%. There are various other measures like the contribution margin, the gross margin, but the widely used profitability ratios are the EBITDA margins or the net profit margins, and you can use these measures in comparison with other companies which are operating in the same industry in terms of a peer comparison. Now coming over to the turnover ratios, these are all relating to the sales. You could have the total asset turnover ratio, which is sales to total assets. Let's assume that sales was 500 crores and you had 50 crores of asset. It means that your total asset turnover ratio is about 10 times, which means that you've been able to generate 10 times of revenue with an asset base of 50 crores. So likewise, you look at something called as a fixed asset turnover ratio, which essentially is look at fixed assets, how much of sales am I able to generate. Inventory turnover ratio, you can either have cost of goods sold as a numerator or sales as a numerator to the inventory to try and understand what is the sort of turnover that you're getting from the inventory. The other one would be the debtors turnover ratio, which is again sales to the total debtors. So essentially all of these ratios are relating to the turnover or the top line of the company. The other important thing that you need to know is on the working capital side, which essentially is the operating cycle and the cash cycle. I think we had sort of briefly touched upon it. Now, if you look at the outer circle, basically in a typical business, you will buy the raw materials with the cash that is available to you, which is converted into various forms such as work in progress, finished goods, the receivables. Now, all the money that you put in initially in the raw material does not come back when you actually sell the finished product. So certain amount of money is locked up in the system, and you will need to redeploy part of this money plus some additional money for your next cycle of operation. So which is typically what is called as the working capital funding or the working capital cycle. Now the inner circle is basically the money released through financing by customers and the suppliers. For instance, in some of the larger companies, you might get advances from your customers for kickstarting your operation. For instance, if you look at companies, large companies like BHEL or Hindustan Aeronautics Limited, for instance, they all get advances from their customers to kickstart their production activities. Or you might also get a very large credit period for sourcing your raw materials or machinery. So the key is, in each of these components that you're looking at, you need to be looking at what is the quantum involved in each of these components. How much of money have I locked up in raw materials? How much is there in finished goods? And how quickly are you turning around from one to the other? The key is to have a working capital cycle which is as short as possible, which gives you the advantage of rolling over your money many times over. So when you look at the cash conversion cycle, it essentially is the inventory conversion period in number of days, the debtors conversion period in number of days, and the creditors deferral period in number of days. Which means what? This ratio, this cash conversion cycle has to be as small as possible. Which means that the inventory conversion period has to be small, the debtors conversion period has to be small. You try and stretch your creditors period as much as you can. A good example here is Amazon. Amazon typically has a negative sort of working capital number of days. What they do is, and I'm sure some of you would have traded on that or any of these other online purchase websites. Amazon typically allows only credit card sales. So you and me would, buy a product on Amazon, and they get the cash from the respective banks within 2 days. But the supplies or the products which they have sourced from various suppliers, they have to pay them only after 45 days or 50 days, which means that they have a huge float of money. They don't need any bank funding for working capital at all, because the customers themselves provide the working capital. So you pay them upfront for them to repay the cash to the suppliers of various products. So the inventory conversion period is basically 360 or 365 days divided by the inventory turnover ratio. That's the ratio that we saw earlier, which is the sales to the inventory. Likewise, the debtors conversion period is 360 by debtors turnover ratio, and creditors deferral period is 360 by creditors turnover ratio. So lower the asset side related turnover ratios, lower is the borrowing requirement, which means that you have converted your assets into cash as quickly as possible. So this is a very key element that you need. And if you look at the SME sector in particular, since we'll be focusing a lot on them, one of the common issues that SMEs face is the working capital requirements are extremely tight, because typically their customers would not pay them in a timely manner. There will always be an extended period of credit with their customers, whereas the suppliers of raw material and other consumables or spares, etc., would demand the cash without much of a credit period. So typically working capital, high levels of working capital typically is a characteristic of small and medium enterprises, because they're caught between a supplier who wants cash immediately and a customer who will pay after a point in time. So the key here is lower the asset side turnover ratios, lower is the borrowing period. One of the most important ratios is the capital structure ratio. Whether it's an SME or whether it's a mid-size or a large corporate. For a bank, this ratio assumes a lot of importance, or any other investor who's investing in this company. So this is also called as a debt-equity ratio. Many of them also refer it to as a gearing ratio or leveraging or capital structure. It essentially is a ratio of the borrowed funds to the owner's funds. When you talk of borrowed funds, you have both the long-term debt and the short-term debt on the numerator, and the denominator has the equity capital and reserves and surplus. For most manufacturing companies, the debt equity of less than 2 times is typically considered as healthy. But SMEs being small sized in operations, typically you find that their gearing or capital structure is on the higher side, because the base itself is pretty small. Some of you might be wondering whether which ratio is good, high or low. High is always good for the owners of the company, but for lenders, a very high debt equity is a risky proposition. The reason being that in bad times, if they're not able to generate enough of profit, then the chances of default on interest and principal to the lenders of these debt can be a problem, which is why this is one of the closely monitored ratios by the lenders, the banks, and any of the other potential investors. Another important ratio is the interest coverage. It essentially is a measure of the sort of cushion that is available with the company to service the interest obligation. Now, the commonly used measure is EBITDA to the interest cost, but there are various other measures that you can use. You can also use profit, the total PBT, also sometimes PBIT, which is also profit before interest and tax, is sometimes used as a numerator to the interest cost. Now, higher the interest coverage ratio, better it is for the lenders, which means that the lender is assured of the solvency of this company, that the company will not go down under. Typical healthy ratios for this are the range of 2 times to 8 times. Now, interest coverage ratios of slightly over 1 is also considered a risky proposition. It means that you just about barely covered your interest obligations. And if any company has an interest coverage of less than 1, it means that the chances of default on the loans are extremely, extremely high. So interest coverage ratio has to be a minimum of at least 2 times, because that gives that cushion to absorb any of these shocks should there be a dip in profitability. Okay, what does DSCR stand for? DSCR is debt service coverage ratio, which basically means how are my profits covering my total interest and principal obligations, which essentially means profit after tax plus interest plus depreciation in the numerator divided by the principal obligations and the interest payments. Now, this gives the overall coverage of the debt and the interest on the borrowed debt. That's a very important ratio to measure. Typically, you'll find that when there are new projects which are being put in place, lenders typically would ask for a projection of maybe 5 to 10 years, and also ask for a detailed computation of the debt service coverage ratio as to how those numbers are moving. So in many cases, the total debt service coverage ratio, if it's 1.3 or 1.4 during the phase of the project and post commissioning that, then the lenders are quite comfortable with that, which means that they're comfortable that all interest and principal obligations are covered in a fairly adequate manner. 1.3 or 1.4 is a fairly adequate sort of debt service coverage. The next set of ratios are called as liquidity ratios. It's the first ratio which is commonly used is called as the current ratio, which essentially means the ability of the firm to meet short-term obligations. So the numerator you have current assets, the denominator has the current liabilities and all the short-term debt. Now, this is typically used by the bankers to determine the working capital. Typically, the range is between 1.2 times to 2 times. Essentially, it shows if I have short-term liabilities and current liabilities that are coming up in the current year, will my current assets be able to cover the current liabilities and short-term debt in a more than adequate manner? So typically bankers look at a current ratio of 1.33 times. Now, if there is a current ratio of less than 1, what does it indicate? It indicates that there could be a problem with the company in terms of meeting the current liabilities and short-term debt, because the current assets are not sufficient to capture that. But there could be some exceptions. For instance, if you look at some of the companies like Unilever, for instance, they will have a current ratio of less than 1. Now, the reason for that is they stretch the creditors very significantly, which means that the current liabilities are quite high. Whereas from the customers, they collect the money in a timely manner, which means that the current assets are not very high. So this is where the question of interpretation comes. You cannot have a blanket analysis to say that current ratio of less than 1 is bad. It has to be seen in the context of the underlying company and the industry that they operate in, and also the terms of trade that they effect, both on the supply side and as also on the delivery side. Liquid ratio. This is also called as a quick ratio or an asset test ratio. It essentially means you replace the current assets from the current ratio with liquid assets. Liquid assets are those which can generate cash instantly. So in the numerator of liquid assets, you will have current assets other than inventories or any of the other prepaid assets that you have. Because inventory, you cannot liquidate inventory the way you want it, because you may not find a buyer. So that is not considered to be a quick or a asset test asset. The next set of ratios are called as the earnings ratios. So all of these relate to the earnings of the company. Typically, you'll find that investors, you might be, those of you who have been reading the financial dailies or looking at some of these finance channels, you'll find that EPS is a number that they keep forecasting from time to time, which essentially means what is the profit after tax divided by the number of shares which are outstanding in the company. It is shown as rupees. This essentially means what the shareholder can claim in the profit of the company for that particular year. Now, a rising EPS signifies that the company's profitability is good and the worth of the shareholder per share is also improving or increasing. But what price the share will command in the marketplace is out of control, because that's purely a function of how the stock market moves up and down. So there are two ways of looking at EPS. One is the basic EPS, which is the profit after tax by the number of shares which are outstanding currently. The other is called as a diluted EPS. Let's assume that the equity shares go up because some convertible instrument is getting converted into shares. Then your EPS will also get changed in proportion to the underlying number of equity shares. So for the moment, for you, it is sufficient to understand that EPS signifies the value per share or the earnings per share. Likewise, you can have, compute what is the dividend per share, which essentially is the dividend that the company declares divided by the number of shares. The dividend payout ratio is essentially the dividend per share divided by the earnings per share. So dividend payout ratio is something that you commonly will see in these annual reports, basically to tell you, what is the dividend payout for a particular company. And anyway, we're going to be talking more about that in the fourth webinar in terms of dividend policies and how companies decide on that. The other set of ratios are the return ratios, which are basically return on investment. And the most critical ratio here is the return on capital employed. Now, many times analysts are typically asked, why is this the best ratio to look at from a profitability or a return perspective to the both the debt holders and the shareholders. Now, the reason why this ratio is one of the most important ratios to look at is, if you look at the numerator, it is profit before interest and tax, which means that this particular ratio does not capture the capital structure. It only says that if I put X amount of money, either through my own money or through borrowings, this is a return that I will get. So it is independent of the industry, it is independent of the capital structure or the extent of assets that you will have in the company. So this is important. Let's say that tomorrow as an entrepreneur, we decide to look at two industries. One throwing up an ROC, return on capital employed of 35% and the other at 25%. We would typically want to look at the industry which is throwing up 35% of returns. So typically for healthy companies, the return on capital should be in the range of 15% to 30%. It definitely has to be more than the interest rate or the cost of borrowing for the company. Let's say the cost of borrowing for the company is 16% and the return on capital employed is only 14%. Then it means that the company is not doing well at all. You're ending up paying more than what you're able to earn as returns. So it is better for the owners of the company not to do this business at all and shift their focus to some business which will end up getting higher returns than their cost of borrowings. Another important measure is again return on equity, and this ratio does not look at the borrowed funds. It only says that the profit after tax divided by the shareholders' equity. This is the return on equity. At times it is also known as return on net worth, because when you talk of shareholders' equity, you're also looking at the transfer to reserves or the general reserves, which are the shareholders' money. So the ratio is also looked at or called as the return on net worth, RONW. So some of the other ratios can be return on total assets, which is profit before interest and tax by total assets. In the marketplace, I think those of you who are familiar with the stock market or trade on that, they also look at the valuation ratios, which is something called as the price earnings ratio, which essentially means what is the market price per share divided by the earnings per share that we talked about earlier. So it is either expressed in ratio or in terms of number of times. So essentially this is used by the investors in the stock market. So typically many of these numbers are forecast. So many times they would compute the earnings per share of the next year and say that the price earnings multiple based on today's market price can be an amount can be so many types depending on the earnings per share. Or there is something called as a trailing 12 months price earnings ratio based on the last 12 months the EPS is computed based on the last 4 quarters, and then you calculate the price earnings ratio. Now, for unlisted companies, since there is no market price earnings ratio does not have make much of sense. Typically, ratios of price earnings during recessionary times can range between 5 times to 12 times, and during the boom times or the peak times can range between 10 times to 25 times. So this ratio is also related to the growth in the earnings as expected over the next 2 to 3 years time frame. Again here, from that ratio you can calculate some ratios such as earnings yield, which is earnings per share by market price per share, dividend yield, which is dividend per share by market price per share, and then the total yield is the dividend yield plus the earnings yield. So just to recap, the ratios that we've looked at are 7 of them. One is the set of profitability ratios, the turnover ratios, the capital structure ratios, liquidity, earnings, return ratios, and valuation ratios. There are some 3 or 4 small caselets that I have before we move to the question and answer session. I'll just take a short break for a couple of minutes. I think you can look at this and see if you can solve it. I will just pull out the Excel sheet in a while now. So the question here is to calculate the interest coverage of the firm. You're given the sales, which is 7 lakhs. The interest charges is 1,50,000. Tax rate is 60%, and the net profit margin is 6%. So how do we calculate the ratio? So the interest is given here at, I think those numbers we've already calculated. So the starting point here is what? The net profit margin is 6%. So you can calculate the net profit. So when you talk of net profit margin, it is 6% on the sales. So 6% of 7 lakhs would give you 42,000. So you calculated the net profit. Now having calculated that, you have to calculate what is the profit before tax. Now the tax rate is given to be 60%, which means that only 40% of your profit before tax is the net profit, which is 42,000. So the profit before tax would be 42,000 divided by 0.4, which will be 1,05,000. And tax is 60% of that, which is 63,000. Interest cost is given as 1,50,000. So you have the interest at 1,50,000 and profit before tax of 1,05,000. So you can calculate the profit before interest and tax, which is 2,55,000. So the interest coverage is profit before interest and tax divided by the interest, which is 2,55,000 divided by 1,50,000, which is 1.7 times. Just to quickly explain to you once more, net profit margin of 6% gives net profit of 42,000, which is 6% of sales. Tax rate is 60%, which means that you only get 40% of the profit before tax as net profit. So divide by zero point 0.4, you will get profit before tax. Interest is 1,50,000. Profit before interest and taxes, interest plus profit before tax. And interest coverage is profit before interest and tax by interest. So 1.7 is not a very good number because it is just slightly over 1 time, which means that the company in all probability is not very profitable. The second caselet is what are the sales of the firm with all these data? The current ratio of 1.5 times, current liability is 8 lakhs rupees, asset test ratio is 1.2 times, and inventory turnover ratio is 5 times. So how do we do this? So the current ratio is 1.5 times. This means that current assets to current liability is 1.5. CA is current asset and CL is current liability. So we are given current liability is 8 lakhs. So the current asset is 1.5 times of into 8 lakhs, which is 12 lakhs. That's the number here. The asset test ratio is given to be 1.2 times. So it is, so from that, you can calculate the inventory values. So the inventory value is 2,40,000 because you know the asset test ratio is 1.5, current asset is 12 lakhs, current liability is 8 lakhs. So you can calculate this figure of inventory. So that comes to 2,40,000. So once you have that, the inventory turnover ratio is shown to be 5 times. So the sales is 5 times the inventory value of 2,40,000, which is 12 lakhs. So the reason why these different caselets are presented here is to show you that there are different linkages between the profit and loss, the balance sheet, and also the cash flow statement. So when you look at a balance sheet, maybe a couple of weeks from now on, you will be able to appreciate the fact that every part of the company's operations or the marketing efforts can be analyzed through the annual report itself. Now, in the earlier example that we saw, the interest coverage was 1.7 times. Here we are saying that current ratio is 1.5 times, the asset test ratio is 1.2 times. It means that such a high current ratio and asset test ratio means that the company is highly liquid is one interpretation that you can make. Obviously, since these are small caselets, to get a holistic picture, you'll have to look at a full company's annual report and try and understand the linkages better. But I think for starters, I think these are good examples to look at. The third caselet is for you to compute the gross profit margin and the net profit margin. So here you're given sales of 2 lakhs, cost of goods is 1 lakh, other operating expenses is 50,000. There is no other data which is given. So how do you look at this? So here, one way of looking at it is your gross profit is 2 lakhs minus, 1 lakh, which is 1 lakh. The other operating expenses is, 50,000. I think for the purpose of this case, we can assume that there is no tax or depreciation. The net profit is 50,000. So gross profit on sales is the gross profit margin, which is 50%, which is 50,000, which is 1 lakh by 2 lakhs, and the net profit is 50,000 divided by 2 lakhs, which is 25%. So this is a largely simplistic sort of example here. The last caselet here is basically to compute what is the return on investment. Here, company A has a capital of 10 lakhs. Its turnover is 3 times the capital, and the net profit margin on sales is 6%. So the turnover is 3 times the capital. Capital is 10 lakhs. 3 times the capital of 10 lakhs gives a turnover of 30 lakhs. The net profit is 1.8 lakhs. How do we get 1.8 lakhs? Net profit margin is 6% of sales. So 6% of 30 lakhs will give you 1.8 lakhs. Return on investment is on 10 lakhs of investment that I make, I get 1.8 lakhs. So my return on investment is 18%. So basically I have tried to put out these cases which try and show these linkages between profit and loss and balance sheet. I think once you have an idea, the idea is not to know what the formula is and how to arrive at those numbers. The idea is to know what is their relevance of each of those numbers which are put out, and how to interpret that number and take corrective actions from a business point of view. So I think I'm done with the presentation. We have about an hour's time for the question and answers. So maybe we can take that up now. Okay. I think Mrs. Prachi Agarwal, let me start with some common questions that people have asked. Please elaborate on EBITDA. I think two of them have asked. I think Mrs. Prachi and Mr. Saha. EBITDA is earnings before interest, tax, depreciation, and amortization. Now, basically, this is a measure of the operating profitability of the company, or it signifies what the operations are efficient or inefficient. So that is the significance of the operating margins. See, from the operating margins, a host of things you can decipher, whether you're pricing your product correctly, whether your market position is good or bad, whether your raw material costs are high, which element of cost is high, whether you'll be able to control the costs or not control the costs. So it is a measure of the overall operating profitability of the company or the operations of the company. That's why it is a significant item. I think what does ALM stand for is Shiv Kumar's question. ALM essentially is the asset liability management. So in this context, basically how your assets and liabilities are matched or mismatched. So that is what the entire asset and ALM means, which is what I mentioned. When you want to acquire fixed assets, you typically will go for a long-term source of borrowing. So that is what the ALM stands for. Now, if you do not go for long-term borrowings and take a short-term borrowing, as I mentioned during the presentation, you could be subject to interest rate sensitivities. Suddenly, let's say you borrowed initially at 7%, the next time you borrow short-term, you might end up borrowing at some 9% or 10%, depending on the impact that the market will have on the interest rates. Okay. Okay, let me just. Profit is not a. Someone has asked, Mr. Kiran, profit is a liability. I don't think I mentioned that it's a liability at all. Okay, the other question is, I think Mr. Saha is building under lease asset or a liability. It is classified as an asset only. So you classify it as a leased asset. I think Srimati Prachi has asked a question, why add back interest? I don't know in what context. If you can just retype that question, I'll be able to answer that. Okay. I think Mr. Vaswani has a question. In EBIT calculation for return on capital employed, do we calculate EBIT before or after depreciation? You can calculate it as profit before tax. You can add back the interest. You will get profit before interest and tax. So you can calculate it after depreciation also. You can calculate EBITDA, which is profit before interest, tax and depreciation. Subtract depreciation, you get profit before interest and tax. Okay, I think Mahesh Swami, you've said some slide. I don't know what you have said. The question is, what is refinancing? Abhinav Gupta. Refinancing is basically you have an existing loan. Okay. Now, if you want to, and if you don't have the cash flow to repay that loan, it can be refinanced. You can borrow that amount from some other source and repay off this loan. So that is refinancing that loan. All you know, the cost of refinancing might be higher or lower. How do you calculate break-even point? I think we're going to be talking about it in detail in the next session, which is, I think, on 8th of April. But just to quickly tell you what it is. See, when you talk of costs, there are two types of costs. One is called as a fixed cost, and the other is the variable cost. And you have the selling price also. So the selling price minus variable cost is the contribution. Now, break-even is when your fixed costs are covered by contribution, then it is the break-even point. That's the point at which all your fixed costs are covered. So whatever number of quantities or capacity utilization that you have will be the break-even capacity or the break-even quantity. So that is the break-even point. Okay, I think Mrs. Chitra has got back to that question. You said profit is owed to shareholders, hence in liabilities. Now, basically what I meant there was, in that example that I meant, the transfer to reserve. Profit there is essentially a transfer to reserve. Transfer to reserve is something that the company has to pay to the shareholders of the company because it is a shareholder's money. So in that essence, the reserves form a part of the liability of the company and therefore should be shown there. Okay. There are so many questions. Let me just pull out some of them. Which of these 7 ratios is most relevant in day-to-day activities? Is a question by Mr. Abhinav Gupta. The thing is that it will have to be, many of these ratios are relevant for all companies, whether it is a profitability ratio or a capital structure ratio or working capital ratio. Now, in terms of what becomes important for the company depends on how many, for instance, the company might be highly borrowed. So in that case, the gearing ratio assumes very important from a external viewpoint. From a banker's viewpoint, the gearing ratio assumes importance. Let's take the case of a company which is not making much of profits. So there, the profitability ratio will have an impact on so many other ratios that we looked at. Now, these 7 ratios that we are looking at are ratios which will be applicable by and large to and important to most of the companies that we are looking at. But within these, which assumes importance and which assumes lesser importance in that pecking order will depend on the specificities of each of those companies. Okay. Okay, I think someone has asked what is the double entry system. This is Smita Shinde. When I talk of double entry system, every activity or action or operation that happens in a company from an accounting principle has both a debit and a credit, which in turn becomes either a liability or an asset, or can also have an impact on the profit and loss statement. So that is a double entry system, which is therefore the reason why that there has to be a balance between the asset and the liability. So that is the double entry system. I think another question which is asked by Saha is, does it mean that for healthy company the asset turnover ratio should be greater than 1? Yes. If that ratio is greater than 1, what does it signify? It means that you have been able to use your asset or the asset utilization has been fairly good and therefore you've been able to churn that asset in terms of giving you greater and greater turnover. So anything over 1, and I think in some of the larger, in some of the better run companies, the asset utilization can be 3 times or 4 times. Okay, the other question is, what is duty drawback? Mr. Rati, duty drawback typically is a benefit which is given to exporters by government, some sort of an incentive which is given back to the exporters. So it is a benefit to the exporters in terms of, some of the incentives given back to the exporters. Which company is applicable for IFRS? All companies will have to move into IFRS over a period of time, and as I mentioned during the presentation, there is a phased manner in which companies will move into IFRS. So typically companies which are, this is a question by Mr. Narayan, and as companies which are large size or having a larger net worth will move into the IFRS over a period of time, followed by the other companies and then the small and medium enterprises. How is contribution calculated? Why is it relevant, Mr. Shivkumar? Contribution is calculated as your selling price minus variable costs, and contribution is relevant from the viewpoint of knowing at what point they will cover the fixed costs. So from a break-even point of view, it is important. Secondly, if you have 3-4 different product lines, there will be different products which will generate different levels of contribution margins. So obviously the ones which generate higher contribution margins are the ones which will be able to cover the fixed costs all the more faster and all the more easily. And therefore the company's efforts and focus will largely be on these sort of products. Okay, capital structure. I think this is a question by Mr. Avnish Saxena. If we have only long-term debt in my capital structure, debt equity of 3 or more is healthier? No. Banks and others look at total debt, irrespective of whether it is long-term debt or short-term debt. So irrespective of whether you have only long-term debt in your capital structure, debt equity level of 3 times is extremely high. What does extremely high mean? Extremely high means that if there is pressure on profitability, when you talk of debt equity of 3 times, it means that the interest repayments and the principal repayments are going to be extremely huge over a period of time, depending on the tenure of the debt which is contracted. If you are being highly profitable, you will be able to make these obligations in a timely manner. But let's say that your profitability is not so very high and keeps fluctuating widely, then with a debt equity of 3, companies typically will be struggling to make it. And typically, if you look at the SME sector, for instance, a debt equity of 3 on a small base can be very disastrous in bad times. Okay, someone has asked, okay, there are so many questions. Okay, first question, what is the difference between fund flow and cash flow? Mahesh Swami. The difference between fund flow and cash flow, as I showed you in that report, is when you look at fund flow, it gives you at one go what the snapshot picture of what the sources of funds were and what the uses of funds were, and also how the breakup of long-term sources and short-term sources are there in sources, likewise in the uses. And you also get an idea if there is a mismatch of funding between the sources and uses of funds. Whereas the cash flow statement shows you the breakup of either a cash surplus or cash deficit in 3 different ways. One from your operations, one from your financing activities. That is, how we are able to get the finance and how, whether it's long term, short term, how we have repaid it. And third is where you're investing this money into, whether it is assets or investments. So that's the difference between cash flow and funds flow. Now, when you talk of, okay, that answers your question. The other question that has been asked by Mr. Richard Vincent Job is, could you reiterate the example of Unilever regarding the low current ratio? When I gave you that example of Unilever, current ratio is current assets by current liabilities. In Unilever's case, the current liabilities are stretched, which means that they pay their suppliers after a fairly reasonable amount of time, maybe 90 days or whatever. Whereas their collection from their customers happens almost immediately. As a result of which the current assets are, that is the numerator is lower than the denominator, which is the current liability, and therefore the ratio is low. Okay. The other question is operating income and the EBIT the same? The answer is no, they are not the same. Operating income is, technically it can be a surrogate for sales. Sales plus all the other related income is the operating income. EBIT is profit before interest and tax. So from the operating income, you subtract the expenses and subtract the depreciation, you get the profit before interest and tax. And I think that was a question from Mr. Ashok. Okay, the difference between maximization and profit maximization and wealth maximization, I think that's something that we covered earlier. So if I have time, I will come back to that question. What is meant by appropriation in finance? I think this is Smita Shinde. When we talk about appropriation in finance, how you allocate various, let's say you have a good example is profit after tax minus dividend, which is your reserve. Now from that reserve, you will appropriate, which means that you will allocate, let's say you had 100 crores of retained earnings. Part of that 100 crores you will put into a general reserve. Let's say 50 crores. Then another 30 or 40 crores you will put into a debenture redemption reserve, which is essentially a reserve that you create to repay your debentures. The balance 20 crores you will put it as a capital reserve. So essentially you are appropriating that into different heads. Okay. I think Mr. Richard Vincent again has got another question. Plowing back of profit. Plowing back of profit is basically again the same appropriation as what it is. See, when you have 100 crores of profit, you declare 50 crores of dividend. So the balance 50 crores goes back as reserves in various forms or various avatars into your balance sheet. When you talk of plowing back of profit, what does it mean? It depends entirely on what the future plans of the company are. Let's say the company has a huge capital expenditure and does not want to borrow much because it is already highly geared. In which case, what does it do? It might possibly cut down on the dividend, and instead of 50 crores, the dividend might be 20 crores. So you are left with a surplus of 80 crores. So this 80 crores is essentially plowed back into the business. It is deployed back into the business into purchase of capital expenditure. So that is what it is. Okay. Vincent Job, ALM. ALM is asset liability management. It is not asset life cycle management. I think there's another question by Mr. Ashwini Kumar. What does PE stand for? PE is the price earnings multiple. How we can save income tax of employee is not within the purview of today's discussion. So, I think, Mrs. Smita, I didn't understand your question on which ratio is mainly used for trading pharmaceutical. If you can just retype that question in a slightly detailed manner, it will be fine. Okay, I think Mr. Yuvanathan, I think you attended the earlier session also. His question is, which ratio indicates the best financial position of the company? Now, it is a combination of various things. If you look at financial risk analysis, you look at a host of ratios. I think if you have good profitability, supplemented by good return on capital employed, a good capital structure, and reasonably good coverage ratios, then you can be said to be financially strong. Now, all these financial ratios have to tie up with the business or market position of the company. Let's say, assume that your company, you're saying that I'm number one in the business. That number one status has to be reflected in the certain financial numbers. It has to get reflected, for instance, in your high level of profitability, for instance. So a combination of these ratios will tell you whether the financial position is good or bad. Vijay's question is it possible to calculate all the ratios of balance sheet, income sheet, and cash flow from the financial report? The answer is yes, and that's how we have calculated. In fact, you should go back, pull out one of these annual reports, and calculate some of these ratios that we did today. Mr. Dheeraj Rathi is from where can we get industry ratio for comparing with companies ratio? There are a host of these research outfits, which pull out these comparisons. I'm sure if you do a Google search, you'll be able to find out which are these institutes or bodies. Okay, Mr. Vineet Agarwal has an interesting question. I had a manufacturing company, business has been good and want to look at taking a large jump, investing and borrowing. What ratios do I look for? I think it's an excellent question to ask. Okay, the ratios that you look at are one, you look at, I think the ratio that I mentioned is return on capital employed, ROC is something that you look at. You would also look at what is your current capital structure, which is a gearing ratio. How will that look after you borrow? The third is the new business going to be profitable? And if so, how will that impact my return on capital employed, my interest coverage ratios? So these are the 3-4 ratios that you would look at if you are going to look at an investment and borrowing activity, and since you're heading the company, this is what you will look at typically. Okay, I think I think that's something that you've answered. I think a lot of you have asked. I think many of you have asked whether this will be available online, Excel workings, PPTs. I think there are almost about 10 or 12 people. I think CI will get in touch with you on that in terms of how and what form it will be put on the net. All of these will be available, including the earlier session on CI online. How and what form it will be put in is something that will be communicated to you shortly. So I'm sure it will be there, but you just need to give some time. Okay. Okay, another question is, I think, Mr. Narayan G. What is return on investment? That's what I mentioned to you. I think the return on investment is what is my profit before interest and tax or profit after tax, depending on how it is, divided by the net worth is one way of looking at the return on investment. There's a question asked, can we say profit before interest and tax is a sum of operating income and non-operating income? Not exactly correct. You can say you have the operating income. We're talking of profit before interest and tax. So you have to obviously subtract the expenses, subtract the depreciation, and add back the non-operating income. Okay, I think Vijay has two questions. Which are the ratios that one should look at while looking at the different companies? And should we consider all the ratios? I think firstly you have to look at whether they are operating in the same industry or not. If they are operating in the same industry, one, from a financial point of view, you look at some of the key 7 ratios that I mentioned. Typically, you look at the profitability ratio, you look at the capital structure ratio, the return on capital employed ratio. Definitely, for sure, you look at the working capital ratio if you're comparing two companies in the same industry. For instance, if I look at cement, I will look at how is my profitability vis-a-vis another player. How is my working capital cycle? How is my return on capital employed? So these are typically the ratios that I will look at. I think Mr. Kiran Rudrappa has a question in terms of what are the ratios that would be of interest for solar power projects. Definitely, I will look at in solar power project. I will look at my obviously I will look at the profitability ratios, but more importantly, I will look at the return ratios, which will be the return on capital employed and also the return on the investment. For these are the two ratios that I will definitely look at in terms of the key ratios, and also the capital structure ratios is something that I would want to look at. I think Mr. Amal has another question. What's the difference between profit maximization and wealth maximization? When you look at profit maximization, you're looking at how am I going to maximize the profit. It can be, the profit after tax typically. Now, when you look at the wealth maximization, I'm looking at increasing the value for each of these shareholders, which essentially is derived from, the activities that you do. What is the value that I'm going to get for each of the shares that I'm going to have? Part of it will come in from profit maximization. Part of it will come in from all the other activities that you do. For instance, ultimately, you have told has to be reflected in the value of the share and the value of creating the wealth around you. So when you maximize wealth, you will also be having profit maximization as a subset of that. Okay, I think Ms. Chitra has an excellent question. Do you have any guidance for a non-finance person managing finance team in terms of improving understanding of domain and then application of the same? Okay, I think this particular series of program is largely for people who are, in different domains within the company to improve their understanding of finance and contribute to improvement of their functioning within their respective domains. I think a few things that one can do in terms of managing the finance team. I think this applies not only to Ms. Chitra, but I think all of you are attending this webinar. I think key thing for you is to go back and sit through what we have done today. I think once this is all going to be put up on the website, try and understand each of these terminologies once more. And also don't stop at that. Also visit various websites which talk about, some of these terminologies. You can just pull out an annual report, for instance, of any company that might be of interest to you from the same industry or, same sector, and try and see how they are performing vis-a-vis yours. Also, read up the financial dailies. It could be any of the dailies that come up in terms of trying to get yourself more familiar with the terminologies, what is happening there, and also listen very intently to the business news. Maybe all of you, since all of you are working, you may not have time during the day, but definitely, as I mentioned earlier on, there are these capsules which come up from time to time. So you can go through that. You can listen to those programs where they will talk of economy, the interest rates, company-wise performance, industry-wise performance, sector-wise performance. I think if you do all of it, I think your job is more than half done, and you should be able to manage. The key thing is to ask the right sort of questions and do the right sort of interpretation from a set of data which is presented to you. Well, it's important to know what is there in the numerator and denominator. You're not expected to physically calculate it because I think that's the job of the finance department. I presume that most of you are attending are from the non-finance department. I'm sure there will be few attending from the finance team as well. The key for you is to interpret the data and ask questions yourself and see how you can, improve the working of your own department. So I think that's a great way of doing it. Does the interpretation of ratio analysis vary within industries? Yeah, obviously it will vary. I think some industries you might operate with a high debt equity ratio, for instance, or you might operate with a low return on capital employed, which means the returns on that business is relatively low. So that is what helps investors decide. I also gave you an example of 2-3 industries with different levels of return on capital employed for an investor to make a decision. Obviously, if I'm an investor, I will choose an industry which has a high return and also look at the other risks which are there in that business and then make my decision. Okay. Okay, I think Ms. Smita has left, so I think her questions can be. Yeah, anti-dumping duties. I think Richard Vincent Job has a question. Anti-dumping duties are in place to protect, domestic manufacturers, and also I think it's there in petrochemical industries. It's there in PVC. This happens from time to time. There are also these limitations on how much you can import from steel. If China typically is a large exporter of various commodities, so from time to time there are these protections which are made for the domestic manufacturers. I think there's a question asked by Mrs. Bose in terms of, are there any cost accounting ratios? Yeah, I think the ratios that you can use there again are in relation to the fixed cost to sales and variable cost to sales, the contribution margin. So those are some of the ratios that you can look at it from a costing point of view. So when you look at, I think the other question is Ratish in terms of is royalty part of COGS or cost of sales. So typically royalty is clubbed along with your selling cost. So typically it will form part of the cost of sales. I think, okay, Pramod Nair is an excellent question. What are the essential readings and its periods from financial statement and ratios as compared to stethoscope reading healthiness overall of a body? Okay, I'm not sure whether I understood your question right, but if I've understood it right, obviously I think when we're looking at financial statements, we are looking at audited statements, and there we are assuming that it's all been done in a fair and a true manner. So it is with that assumption that we are looking at all these ratios. Now, what are financial numbers and ratios? Now, these are typically manifestations of how well or bad you have done a business. So if you're a strong player with really high level of standing in the business or market position, then that has to get reflected in the numbers. So many times during the course of my work as a consulting for various companies, both large and small, some of them would say that we're extremely strong on the business. We think we are number one in the business, but actually when you look at some of these numbers that throw up, like profitability, etc., they're pretty low. So which means that obviously they are not number one in the business that they operate in. So a detailed analysis of the finance only confirms whether you are doing a business well or not doing the business in a manner that you want to do. So the answer to your question is that the overall financial health and the overall health of a company can be very well obtained by looking at some of these ratios. That's the whole purpose of it. And it is also a check for the management from time to time. While you and I might look at it at the end of the year, the management is constantly looking at many of these ratios. For instance, let's say that the cost ratios go haywire. What does it mean? It means that the profitability for the company is dipping from time to time. And therefore, there's an urgent need for the management to control their costs, either cutting raw material costs or cutting your employee costs or doing something to arrest the slide in margins or trying to increase the price of the product. So I presume that answers the question, Mr. Nair. Okay. Okay, Gopal has asked a question. Maybe I think mca.gov.in. Maybe we can talk about it, Gopal, later on after the presentation. I think it should be there. Okay, I think Mr. Mahesh Swami has a question. The presentation is mainly for manufacturing companies. Is there any presentation for cash flow statement or infrastructure company? No, largely I think what this applies is largely for all companies. If you look at infrastructure company, also you will look essentially in the same manner in terms of what the inflows and outflows are. I think cash flow is same whether it is manufacturing company or the infrastructure company. Maybe some of the ratios that you would look at for an infrastructure company might be, the focus might be a little more on some of the cash flow ratios. Typically in infrastructure companies, much of the activity, let's say that you have a new infrastructure company, maybe the first 2-3 years, nothing much is happening there in terms of cash flows being positive or cash flows being healthy, because it takes time for the project to get stabilized and much of the returns happen over a period of time. So there essentially for infrastructure companies, which is true, even if you look at mobile telephony or those sort of companies there, essentially there the focus might be, because there's a lot of cash coming in and going out every day, more of a retail sort of thing. There you will typically look at cash flow related ratios, or the focus has to be more there, not that you will neglect the debt ratios, for instance. So in infrastructure companies, the accent, or for that matter even for construction companies, the accent will be a lot more on the cash flow related ratios. You look at ratios like cash flow from operations, for instance, in relation to the total debt of the company, might be one ratio that you will look at. Or you will look at the debt service coverage ratio, how they are going to pan out over a period of time, and what are the various stresses that will happen. So those typically will be the sort of ratios that we'll look at. Someone wants a recorded copy of the presentation. Okay, I think Mr. Majumdar, I think you asked what is